We are just going to go over IULs more or less in just a basic sense, so you understand the background on them, and then more or less how they function, how loans work, how you can actually take money out of it, and what that actually looks like. Okay. Let's go ahead and click over here. Overview. What is an IUL? Why get an IUL? How loans work? Buying a rental property. 3 ways to fund it in 4 phases. So this matrix right here, I like to show to the clientele when they want to see some type of presentation. I use this exact presentation with the client, but this chart shows where most 401ks, IRAs sit in the mutual funds and individual stocks, which have 0 guarantees, meaning you can lose all your money. Very, very simple. Variable life insurance. Have you ever heard of a variable life insurance or like a LIRP life insurance plan?
Yeah, that's more an older type of a policy, but yeah.
Yes, it is. But most of them use a variable life insurance to be able to achieve what they're looking for, because individuals have the ability to choose what stock, vice the company basically choosing where they decide to invest their money. So partial guarantees, because if they choose the wrong stock, they could go under. So still a little risk. Now flip over to the opposite side. Banks, this is where most people keep their savings, significant amount of money, because they believe it's the safest spot. They can't lose money due to the market because it's FDIC insured. Do you know what FDIC actually stands for?
Federal something.
Federal Deposit Insurance Corporation. So it's an insurance company. So the banks go to the insurance company to ensure their money isn't going to go anywhere. Now, the FDIC only insures up to how much money? Do you know? 250.
No.
250 is the magic number. So if you have more than 250,000 inside of a bank account, you're at risk to losing it. So if you have 300,000, you're 50K at risk. Okay. If the bank goes under. Now, the unique thing is if you just take that money and go and own the policy instead of going to the bank, and the bank owns the policy and the bank more or less gets to control it, you get to control how much money you put in, and lo and behold, you have ultimate safety from the insurance company because they have a 1-to-1 solvent ratio with their death benefit, meaning if they guarantee you a $300,000 death benefit, they can cover your $100,000 of cash value in there. Any moment your cash value moves up, your death benefit moves up. So the company always has your money on hand. Does that make sense?
Yep.
So if you have more than 250,000, it's very smart to move the money into an insurance product like a fixed whole life product or an index universal life product, because you have the safety, but you also, so you have dual safety. You have safety from any of the banks going under, your 1-to-1 solvent ratio, so you'll never lose money in that fashion because of the institution. And then 2, you're safe from all market loss. So it's the safest form of parking your money from all risk. Now, is there any risk inside of one of these policies? If you make a fixed whole life policy at 4%, you're not going to kill those policies. An IUL, if it's structured incorrectly, meaning you have a really, really, really high death benefit for a really low amount of cash value going in there, you could kill the policy. But very rare that is done with our group of individuals. That's the reason why most IULs have a bad rap out there, because advisors go out and make a really big death benefit and a really small premium. So they get to keep all the money. But any questions?
No.
Okay, awesome. So a little bit of history. I won't go too crazy into it. 1851 cash value life insurance came about. It was whole life. 1979 universal lives came out the same year as 401ks. Okay, so ironic that a retirement vehicle came out and a safe insurance product came out the same year. Same thing happened in 1997. An IUL, Index Universal Life, came out the same year as a Roth IRA. So 2020, a new law went into effect that allows 2% more premiums into IULs. From 2020 to 2021, there was a $60 billion increase in the insurance industry. That was a threefold over the year prior because of one law change. Why? Because to me, and no speculation, I'm not a conspiracy theorist by any means, but 2020, 2021, that's when COVID hit. They knew it was coming. They put a law into effect here right before COVID hit. Or no, sorry, we were in COVID at that point. Midpoint in COVID, they came out and said, there's a new law, let's put money into an insurance product that's completely safe from all the negative returns that came in 2022.
Perfect.
So I'll let anyone connect the dots there, however you want to do that. I'm just giving you the numbers and the statistics there. Section 72 Echo out of the Internal Revenue Code states that loans are tax-free. 101 Alpha, death benefits are tax-free to your heir. 7702 is just a definition of a life insurance contract. So if you ever see someone advertising a section 7702 plan or a TFAP or a LERP, most people are pointing people towards an IUL. They're just renaming it so it sounds better, if that makes sense.
Yeah.
They just don't have to use the words life insurance or IUL. They just a tax-free retirement account. Like they're just naming it other things to advertise, if that makes sense. Any questions?
No.
Okay. Features, contributions. This is more or less no contribution limits because you can just change the death benefit. If they want to put in 20,000, you just give them a higher death benefit. If they want to put in 40, higher death benefit. It's very, very simple. When you go to set it up, you can set it up with flexibility, or you can set it up for complete cash growth. It's completely up to the client. When we get to more of the explanation of the illustrations, I'll show you what I mean by that. Tax-free, well, if you got money in the bank and you make 0.001% on your money, you still have to pay tax on that money, which is just behind the bank. But you still do. IRA, depending on if it's a Roth, obviously you don't pay any taxes in Roth, but a traditional IRA and a traditional 401k, you pay taxes. So nothing there. Employee contributions, you can set it up to where an employer can pay your IUL.
Okay.
We will eventually have like John Hancock for group IULs. So nice. Most people don't know that, but there's 100% possibility of your employer paying it. Investment options. The reason why I say investment options is because you can pick from different indexes.
Yep.
No withdrawal penalties. So if you're underneath 59.5, there's no 10% penalties there. There is no RMD. So when you hit 72 and above, 72.5 and above, you do not have to take distributions. It can stay in there and grow. And then low risk, we already talked about the two safeties there that are more or less tied in, and we can throw a third safety in there and going, well, if you put 100,000 in, like if you build up your cash value to 100,000, you have 300,000 death benefit, you just 3 extra money by passing away. That's a third layer of, risk free.
Yeah.
So there's just so many you can do. And I mainly, just so you know, the main points that I use to present the product is asset protection and reduction in taxes into retirement. Those are my two hot points that I typically go on. Not cash growth. I don't focus on cash growth. I focus on what the product can do outside of the product, if that makes sense.
So whenever an individual dies with one of these, does the person getting the death benefit, do they get both the cash value and the life insurance benefit combined?
It depends on how we set it up. There are more or less 3 different type of death benefits. There's a level where a level death benefit, if you have $300,000 death benefit, you get $300,000. That's it. Okay. No matter how much money you put in. Now, an increasing death benefit, or option B, they're named two different things.
Mhm.
If you have 100,000 to start with and you put in 5,000 of premium that year, you now have 105,000 of death benefit. Make sense? So
Yeah.
you get premium and death benefit in that scenario. Then the
Mhm.
third option is a graded, and that's more or less an increasing to a level death benefit when you withdraw money. It's just the best structure when it comes to pulling or growing cash, and the safest when it comes to pulling money out.
Okay.
So level, you get just the death benefit. Increasing, you get both. But most of the time when you go into retirement, you want level because of the lower amount of fees that you incur.
Okay.
So basically, in a sense, what I explain to people for that is when you are ramping up and building cash value, you're going to get cash value and death benefit. But when you turn around and you start drawing from it, we need to keep fees low and have you have the ability to touch all the cash. So that means they just get the death benefit at that point because you're using the policy.
Yeah.
So two different ways to bank. I just like to go over this because everyone hears the theory becoming your own bank.
Mhm.
So I always like to just show them that there are two different ways to bank. Traditionally, if you had 100,000 sitting in your bank, you'll get a 1% on a jumbo savings. That is $1,000 you made, which is taxed. Then how the banks make money, they take your 100,000 and they get a 7% ROI. They're going to go either put it into life insurance. They're going to go put it into, option trading. However, that bank decides to go make money, that's how they're going to go do it. They typically get 6 to 7% on your money, which means they make a 600% return because they never used their own money. They used other people's money. So you take a measly 1,000 when you should have got $7,000 of profit. Now, if you utilize an IUL, and obviously I always explain $100,000 is 10, 15, 20 years down the road. This is not a get rich quick scheme. This is something that you have to use and plan for the longevity of your family and generational wealth. This is not a short-term product. And I explain it here in that sense. 7% growth is pretty average for a policy. 7,000 completely non-taxed. All goes inside the IUL. Nothing goes to the bank. Boom. And just showing here in most cases, you would have a death benefit around 300 to 500,000 if you had $100,000 of cash value. Okay. The difference here is fast access to loans. You do not need to get approved because it's your money. So 24 to 48 hours, you'll have the money. You can request it online or over the phone. 4 through 6% loan rates can be 2, depending on where you keep your money, if it's in a fixed account or if it's in the indexed account. And I'll explain that a little bit later with the two different loan types. Making money while borrowing your own money. If you borrow at a 4% and you make money at a 7%, you make a 3% spread. If you borrow your money out of here, you take all your money out and you just are, you're at a negative immediately. So even if you get a 1% spread, it's better than absolutely nothing. Even if you get an even spread of 4% to a 4%, you still made money that year if you didn't take out 100% of your money. Emergency fund, obviously, just it's nice to be able to touch that. Whenever you have cash value in there, you're allowed to touch it. So if you're building it up and you get like 2,000 in year 3, you can borrow 2,000.
Okay.
Any questions on this?
No.
Okay, awesome. So why get an IUL? Well, there's a whole bunch of reasons: cash value accumulation, tax deduction, and diversification. This is the one that I use the most to sell off of because I can show someone at the end of 20 years they can save $2 million in taxes. They're going to be really happy. So tax-free retirement income, obviously most people know that. But the thing is, most cash growth that they see in here, they're not like overly at the top because it's only 6% getting illustrated. So if they're looking to get 12, 20%, it's going to, deter them to go, I'm not, there's not much cash growth. It's what the product does for them that they don't understand. Death benefit, estate planning, strategic rollouts. This is a very unique strategy, very advanced. I'll explain this when we get into the illustration, but this is very unique. We can take people's 401ks when they're over 60. We can take people's 401ks and completely roll them over completely tax-free using this strategy. So it's very unique. You don't have to put it into an FIA. Typically, you have to move someone's money into an FIA to not have taxes, but there's a way we can move it into an IUL with no taxes. Working capital for businesses, real estate, lump sums, very interesting things we can do. We can take someone who dumps in 200,000 in the first 5 years, and then every 5 years after that, he can take out 50,000 and go put it into a new chunk. So after 20 years, he has 4 different properties, and he still has 200,000 sitting there to go put into other properties. So very unique ways we can do that. Emergency funds, college funds, and then obviously your living benefits that you have in there, and then people just becoming their own bank, being able to borrow and use their money in 2 places. Top 5 reasons. Highest return potential. What I mean by highest return potential of a safe product, completely no market loss. You're not going to beat the safety of an IUL with 0 loss from the market. Greatest flexibility, depending on how you set it up. If you make a truly max funded policy, it's not that flexible because you're at the top end. There's ways that we can set it up, and I'm not saying give them the lowest amount of death benefit, but if someone comes to you and goes, hey, I want to put in, $500 now, and I want to dump in 10,000 at the end of the year, you can set it up to allow that to happen. Okay. So they can be very flexible. Tax-free capital gains, everyone already knows that. No Social Security impact. What I mean by that, to give you a very easy example, if you have 100K in a 401k and 100K in an IUL, you're going to take out, let's just say you're taking out the 100K of income out of those for that year. Okay. A 401k, you're going to get taxed 24% because that's going to be your bracket of income that year. Okay. So you're going to go down to 76,000 of income, plus you're going to have a smaller Social Security benefit because you just showed 100,000 on your, or 76,000 of income on your tax return, right? So you might only get a $30,000 Social Security benefit. So you're at 106 income. Vice, if you take out 100K out of an IUL, all that money is not reportable to the IRS because it's a loan. So you get 100K tax-free. You show nothing on your income tax. So you get the total 50K Social Security at your age. So you get 150K, vice only getting 106K.
Yeah.
You see how powerful that can be once you stack that 10 years. You just made an extra 500,000 just simply by having your money in a product that keeps you flexible and hide your income from the IRS.
Yep.
And more or less, that's how I sell to be able to get them to go, wow, I can make an extra $1 million in retirement in 20 years. Yes, you can. It's very simple. So the thing is, it's not the fact that it's a conservative growth. You trade off the crazy 15, 20% growths to have 0%, but you sustain 0 taxes all around, which ultimately means you're getting more income than even if you were getting 15% in your 401k because you have to pay taxes on capital gains. So it lowers everything. So it's a nice little hack once you can explain this to individuals and you feel comfortable explaining that process to them. And then obviously death benefit. Some people, I'm telling you, just want the death benefit. They're like, hey, give me the minimum. I just want to have, $1 million death benefit until I die. If there is some cash growth, because I'd rather not throw my money away. If I need to borrow from it, that'd be great, but that's not the main purpose. Those ones are the nice ones, to be honest. Those are the ones where you're going to get the whole amount that they put in. You're going to get at least 1 or 2 of these a week. So it's going to make up for making the custom policies that you might not get the full, 12K annual premium. You might get 8K, but you made them an extra 300,000 in the retirement. So it's, for me, I'm always going to side with the client because I know 2 or 3 calls down the road, I'm going to get a generational wealth piece one, and I'm going to get the full payday. So I know these are in there. So I customize it to the client every time. So how loans work, very, very easy concept to understand. $200,000 of cash value, 600,000 of death benefit in this example. Okay.
Okay.
In this example, they're going to take a 10% loan. They're going to take out $20,000. They take out $20,000. They can only borrow 180 because they took out 20. Okay.
Yep.
But 200,000 is still growing interest. Why? Because the 20,000 being borrowed came from the death benefit. Okay. So that 200,000 never left the cash account. So it never got touched. That's where the concept of untouched compounding interest comes from. That's why this product is so powerful, because it keeps on compounding year after year with a new total, which means you're able to make more money and take more money out each year.
Yep.
So you're growing 200K because you're borrowing from the death benefit. Current loan rate for this example is 4.5. 6% on the total of 200,000 is 12K of profit. Now, to calculate the loan fees, we're going to do 4.5 of 20K is $800 worth of loan fees. For him borrowing 20 grand out of this policy, he still made 11.2.
And where does the 11.2 go? Does it go to the cash value or back to the death benefit?
Nope, this goes right back to the total. So next year when he does the compounding interest, it's going to be off of $211,200.
And then does his death benefit always stay at 580,000, or does it go back up to 600,000 eventually?
The thing is, the individual can pay back the loan 3 different ways. And this is how I always say, you can pay it back on death, which then means you'll always have a 580 death benefit.
Okay.
2, you can pay it back in lump sums, or 3, you can make a payment plan. It's your money. You can decide how you pay it back. So if he always keeps the 20,000 out, it's going to lower the death benefit. So when you get into retirement, you take money out, it lowers the death benefit, but it's your money and you're living with it. That's why we change it to a level. So it can have less fees than always trying to keep $1 million death benefit while you take money out. It's just going to make a bigger pot of fees if you do it that way.
Perfect.
Any questions?
So then that person can, you could borrow the whole death benefit then.
You can to a point. When I say that, you can only borrow what you have in cash value. You can never borrow more and over leverage yourself. They're not going to allow that. It's not like you can sit here and go, I want 400,000. You can't do that because you only have 200,000 in cash value.
Okay. So if somebody has only 10,000 of cash value,
you can only borrow 10,000.
Okay. Makes sense.
And that's the one catch. And you get that a lot. Some people go like, oh, I want $1 million death benefit. When can I turn around and borrow $1 million? Nope. Nope. Stop. That's not a thing. I wish it was. If that was the case, man, these things would be selling even hotter than what they are. That, and then you always hear the covenant. What you put into this each year, you can deduct on your taxes. This is not a retirement plan. This is a life insurance policy, which means it's not favored as a tax deduction. So whatever you pay is what you pay.
Makes sense.
I always like to show this using an IUL for investing. What I mean by that is property. Okay. There's 3 different ways you can buy a rental property for the most part. The first one is a cash buy. The second one is traditional financing. You go, you go to Huntington Bank and you get a loan and they go, hey, perfect, here it is. And you start paying the mortgage. Lastly, you can borrow from your policy if you had 100,000. Okay. Now, 30 years mortgage at 5%. You can obviously tell if you borrow 100,000, it's going to cost you almost 200 grand to borrow it for 30 years. Okay. So that's just the fees of the mortgage. Now, 3% property appraisal over 30 years. Everyone is going to get that one because they own the property. Lastly, net cash flow, $1,000 of rent. Everyone gets it. But the one unique one is the cash value at 4.5% for 30 years. Because you borrow it, your money's still in your policy growing. You
Yeah.
never technically took the money out. So you make an extra 384. So once you total them all up, cash is obviously going to beat traditional financing because you don't have the additional fees. But even with the additional fees of you paying yourself back, because you're borrowing your own money, you almost double what everyone else makes while having complete asset protection, where if you passed away, the entire rental property would be paid off in full and your family would have an entire cash flowing asset at $1,000 a month.
Perfect.
So I always like to show this just so they can see very simple. When you borrow from your policy, you can leverage it in multiple different ways. And if you do pass away here, that loan's taken care of. If you pass away here, your family better hope they keep their tenant. So I always, whenever I talk to real estate investors, I always let them know per rental property, you should typically have an IUL. If you have $1 million policy and you have 5 properties all underneath 200,000, that's fine. But you need to have an IUL per couple properties to make sure you have perfect asset protection, where if you pass away, your family's not worried at all.
Yeah.
Nice thing is if you put the net cash flow from the rent into your IUL policy, you then get to utilize it in 2 ways tax-free. So it's so many benefits when you incorporate an IUL into real estate investing. Any questions?
No.
Awesome. 3 ways to fund it. This is very important. I go through this with every client before I ask for the money. I don't ask for the money without going through how you can pay and when you can have access to it, because without doing that, I feel like I'm doing a disservice and I'm just waiting for an objection to happen. I like to fight them before all of them happen, if that makes sense. So monthly, common type, max funded account with lowest death benefit, highest cash value. This is where they go, hey, I got $300. I only want to pay $300 for 30 years, nothing more, nothing less. I'm giving them a max funded account. Okay. Now, this is typically year 1 to year 3 is when you have access to that cash value. It's not going to be a lot of access to it, but you're going to have a little bit of access to make an emergency fund. Now, typically monthly contributions for retirement are $500, $750 to $1,000. Now, the second way to fund is lump sums. With lump sum payments, typically if you come to me and you're like, hey, I have $100,000, you are a 40-year-old, I'm going to take $100,000, split it into 4 years, $25K into the policy for 4 years. You put $25K in the first year, you typically have access to around 45 to 50% of that money right away. After you're done funding all 4 years, you have access to all your money. It's very simple. This is mainly towards the real estate investors, 1099 business owners, or the pre-retirees trying to move over lump sums from 401ks. Access, obviously, from year 1. Combination is, honestly, this is where everybody sits because it's the most flexible. This is where you do monthly and you can dump in lump sums. So targeted, usually people who have 5 to 10,000 in their savings, they want to dump in to start the cash value, but they want to also save for retirement at the same time, build generational wealth. 500, 750, and 1,000. But that whole time, and just so you know, that's how I present it to the client for the most part. And I kind of sped through it there, but I did not use small numbers. It's 500 as the lowest number because we're helping them out with a retirement account and building generational wealth. This is where we're going to stand on, and how we get higher premiums is simply by not going, let's get you started with $100. Let's just get your foot in the door. We do not use those words because those are chargebacks waiting to happen in an industry like this.
Yeah.
So no sense of that. Any questions on this?
No, that's not a problem at all.
Awesome. So lastly, I just like to go over 4 phases. You can switch this up. You don't have to. I just have this in my presentation so they know right when I get the money from them, because typically right here at the beginning of the slide, I go, just let me know which way makes the most sense for you. At the end of the slide, and I get through this and I go, oh, okay, well, I want to put in maybe like 5,000 to begin with and pay, $600. Can I do that? Oh yeah, we can definitely do that. Let me just go through the 4 phases with you. The first phase is what we're going to be doing today. We're going to find a company that best suits you and more or less build you out a couple illustrations. You're going to pick from 3 of them. Once you pick the one that you like, we're going to see if we can find a company that can get you approved. Typically that takes anywhere from 5 to 7 days. Now, phase 2 is acquisition. This is after you get approved, the first premium going into the policy. This is where everything goes into force and you have that death benefit and the living benefits automatically. Okay. The third phase is where you go to fund it. And for you, you're going to be funding it until you're 65. So it's going to be now until you're 65. And don't get me wrong, you can touch it for emergencies, but the point of the fund is to get as much in there for retirement. And then lastly, phase 4 is just profits distributions. This is where you can touch all the money tax-free and you get to reap the benefits of your hard labor and discipline throughout the years. Any questions on this?
No.
Okay, perfect. And then I just ask any questions and then I go straight into WinFlex and start building out the different policies with them, show them 3 different